the four people you see here who have all been either, for me, in corporate governance, but in operating businesses that are directly relevant to what Target does. So I have no reason to think that Pershing Square is in this for the short term, but the fact is, whether they are or not is irrelevant to what the four of us are going to do inside that boardroom.
If I could just quickly address your question, again, hedge funds are normally accused of being short-term. And by the way, there's nothing wrong with that. I mean, there are plenty of short-term traders that do a much better job than we could trading stocks. We tend to take very substantial positions, and we tend to be a holder for multiple periods of time. I've gone on very few boards, and the reason why I've gone on very few boards is that it takes a lot of time and energy. It restricts you from trading, and I really have to believe that I can be a multi-year holder beyond this point in time in order to be willing to give up the kind of flexibility you have when you join a board. Pershing's been a shareholder of Target for more than 2 years. By joining the board, I'm indicating that I'm going to give up flexibility in terms of trading. So that should suggest to you that I think there's a lot more value to be created from $43 a share, over time. And by virtue of my willingness to give up restrictions, there's nothing I can do to prove better that I'm in this for the long haul. Yes, up front here.
I wonder if you could address the timing issue a little bit. I mean, a lot of the arguments that you all have made collectively relate to an economy in a downturn. If we are, in fact, sort of coming out of this, do these things make as much sense as they might have, say, last year? I mean, we're talking about spinning off the real estate. Maybe we should wait till it's worth more. Credit card may actually become an upside if credit improves. And then the food business is something that, Target differentiated itself with more discretionary items. And if the economy improves, wouldn't that be an advantage for the company to have now?
I think we should just go through each of the different disciplines. I mean, what's your view on food in good times and bad?
Again, having not sat in the boardroom and going by what Greg said, food is in their future. With regard to rolling out the super targets as well as their add-ons and their remodels that put more consumables in the past. I think if you look at in good times and in bad times, that the consumables still drive traffic into the stores, which would bode well for them on the specialty side, the apparel side, the general merchandise side, in those individual areas. But the big thing is if they're going to continue to compete with other mass marketers, particularly Walmart, they're going to have to insert themselves to be more competitive, item for item, SKU for SKU, and get into that business. So whether it's good times or recessionary times, I think that that getting into the food business will actually continue to increase their volume on a total revenue basis going forward.
And I think it will also more readily insulate the company from this happening again. I mean, we don't know how long the economic downturn is going to be. We don't know when the next one's around the corner. You don't want a company that only does well. I think the conditions of the last 5 years are a lot more anomalous than they are regular, right? So you don't want a company that only does well in a boom, credit cycle, because I think this generation, it's going to be a very long period of time before we go back to the kind of home equity extraction, and CDOs and other technology that created a lot of credit in the market.
But in addition to that, if you look at Walmart's analyst reports, they're talking about the abundance or the oxygen that's left just in the U.S., empty spaces for supercenters or their neighborhood market concept. So there again, I think you have your chief competitor getting more deeply in this business. And I would think, again, not knowing, they'd want to do it as well.
Richard, thoughts on credit?
I think the timing issues on credit cards are very important. And it could very well be that now is not the time to do something on credit cards. I don't have the particulars of Target's situation, but you would like a situation where margins or credit trends are more stable, where the universe of buyers has increased because the capital structure of the potential buyers is in better shape. But even if the current economic environment were benign, I think an important thing to recognize about the credit card business is that structurally, the secular trend through time has been towards higher capital requirements in that business, lower margins because of increased competition, and now, more recently, a lot of attention from regulators and legislators. They're going to decrease the flexibility in that business. I think it's not the place to be creating wealth for shareholders that it once was. And so the issue, I think, is a real one.
I mean, if you look at Target's credit card business, I'm a big believer in companies. Michael Porter serves on our advisory board. I'm a big believer in companies pursuing where they have a competitive advantage. Target has an enormous competitive advantage in its credit card business in terms of acquiring customers cheaply. Because when Mrs. Smith walks up to the counter with $400 worth of stuff and she pulls out her American Express card, the person behind the register knows to say, hey, would you like to apply for the Target Visa card? We'll give you 10% off your purchases today. And that induces Mrs. Smith to apply for the Target Visa card. A bank has to spend several $100s to try to acquire the same customer. That's an enormous competitive advantage. Target's a great marketer, right? So another competitive advantage. They have great customer service. That's a competitive advantage in running a call center. But Target does not have a competitive advantage in terms of accessing deposits, right? It doesn't have a deposit franchise. It doesn't have the kind of low-cost capital that a major financial institution has. It doesn't have the economies of scale that enable it, or the experience in running a business over many, many different credit cycles, or it can't afford to have the same number of PhD statisticians analyzing the data. It doesn't have the benefit of mistakes made by other retailers. So I'm of a view in a company pursuing its competitive advantage. I also think there's a question of focus. I have to believe that the credit card operation is consuming an enormous amount of not just Doug Scovanner's time, but I have to believe it's taking meaningful mind share away from Greg Steinhoffel because of the fears incumbent in that business. And every time he goes to a meeting with a shareholder, I'm sure that they're getting questions about the credit card business. They had a major financial institution that was on the hook with them. It's kind of like a stock ownership. The beauty of a bank taking credit risk is they're really going to care about underwriting. They're not just a low-cost form of financing. So I think that transaction makes sense in any marketplace. Now, the exact timing of what you do and when you do it, I think it depends on the conditions, the factors that Richard mentioned. Michael, any thoughts on real estate?
Well, I think it's since the problem hasn't been really addressed, or does not appear to have been addressed, it's not an issue that's going to get resolved very quickly. You have 200 million square feet of space. You have it managed in a number of different ways. If you look at this slide sheet on page 55, you can see that none of the major retailers in America have taken one position or another. The Walmart's halfway leasing, halfway owning. This is a process that's going to take some time to figure out what, for the company, what is the best use of their real estate, where it should be.
I mean, none of the
I guess my second point would be, this is a capital consider. This is a right